One thing we can all agree on is that we want to pay less tax, and we want to pay less tax while we're in the accumulation phase, building up our nest egg, in the decumulation phase when we're drawing down our investment accounts and living through retirement, and also in our estate. We want to pay CRA less money when we die. The idea is for later in life, when you get to the end of life, that the majority, if not all your assets, are structured in a way that they pass on absolutely tax free. And today we have John Kootenay, who's one of the CFP professionals on our planning team at Parallel Wealth, join us to talk about estate planning. How can you utilize certain assets and accounts to make sure you pay less tax along the way, but also at death? John's been in the business for over 10 years, been building retirement plans for our team for a few years here now, and really understands the deep concepts of digging into tax planning, structure, and all of that. So let's welcome John to the channel, and we'll link his contact information below as well. Again, part of our fee-for-service planning team here at Parallel Wealth. Well, thanks so much, John, for joining us on the channel. It's good to finally have you on here. You've worked with us for a while. I want to get you on here more often, obviously, but we want to cover estate planning today. And what does that mean? And how can our clients and viewers better utilize their assets they've built up? So the first question I have is, what are two ways Canadians can create a better tax position later in life for themselves?
Well, when we do plans here, generally what we're looking to do is have a primary residence and tax-free savings at the end of the plan. So that's really at the end, you have a very tax efficient estate because of the principal residence exemption and tax-free savings account is tax-free. But that's kind of the end result. So really, how do we get there? And it's, saving when you're working. So paying yourself first, using a variety of accounts. We talk about the RSP meltdown throughout retirement, but generally at the end of the planning horizon, age 95, we're looking to, generally speaking, have tax-free savings or the primary residence there.
Yeah. So even though you might be building up kind of RSPs and first home savings accounts and other types of accounts through the accumulation phase, in the plans that we put together for clients, it's really that decumulation phase is, okay, if you have extra, let's make sure we're kind of shuffling as much as we can to the tax-free savings account so that when you die, again, we all want to pay CRA less money. So, the more we can get to the principal residence to the TFSA account, the better off you're going to be.
Yeah, we look a lot at the tax projected to the estate. And if we can, if we have to move money from a registered account or a non-registered investment account and get that sheltered within the tax-free savings, and we can do that in a tax efficient manner, then we'll do that in that decumulation phase. And that end result does become a tax efficient estate.
Yeah. And we've talked about it before where drawing money out of an RSP or out of a RIF may not be, hey, you need this income. It's more of, okay, it's a tax planning play, leveling out the tax rate. And we're going to take that extra few $1,000s and actually put it into your tax-free savings account. So again, creating more tax efficiency as we go forward. So, and then like how and why are the principal residence and the tax-free savings account good ways to do this?
Well, the tax-free savings account, there is no tax.
Void it all together.
All of the investment growth is completely tax-free. So whether you're earning dividends, capital gains, interest income, it really, as long as it's an eligible investment, then it's going to be tax-free at the end. So
Yeah.
that's very efficient. In terms of the primary residence, there's the primary residence exemption. So when individuals dispose of a property, and whether that's through your will or if you dispose of it during your lifetime, generally speaking, that would be eligible for the primary residence exemption. And with that clause, that there's no tax payable on the growth.
And that's one thing with the principal residence, we see a lot of, and I've actually had a few conversations with prospects the last few days, is people are downsizing their home. So they have kind of built up their nest egg. And to simplify things, they've downsized their home, but now they have all this cash, or maybe they've sold their home and they're renting, and they have all this cash, and it's like, well, like my TFSA is maxed out, I'm going to non-reg. It's actually producing all this income now, and they're getting OAS clawback and that kind of stuff. So you need to kind of think through like longer term if you're going to sell or downsize your principal residence. In fact, for some of you watching this video, upsizing and spending more on your principal residence might actually make sense because it's a way to tax shelter money both while you're alive and at death too. So if you're in a situation where you have more money than you need, buying a bigger home or a more expensive home might actually be a good tax strategy in the long term.
It certainly could be. And you look at places where property growth is quite high. Like we talk a lot about Toronto, Vancouver, like these really booming areas where you see, pretty outrageous property growth. To have that be tax sheltered is just another way to diversify a portfolio when you look at the big picture of things.
And then what are other ways or areas people should focus on in creating a more tax efficient estate?
There's a few things you can do. So, especially in the case where you have more money than you're going to spend throughout your lifetime, you might look at charitable donations throughout your lifetime. And there's a variety of ways to do that. Making sure that you're taking advantage of all the tax credits and deductions that are available. Make sure that you have appropriate beneficiary designations on all of your registered accounts. You can name a successor holder on your tax-free savings account
It's
if
a
you
big
have a
deal too.
spouse.
Yeah.
So that's a huge one there. And then also that for life insurance policies, that can help minimize probate fees and streamline your asset transfer to your intended heirs while minimizing tax implications for those beneficiaries.
Yeah.
And then when we get into, higher net worth planning, sometimes we'll look at permanent life insurance as a way to diversify a portion of a portfolio. And that can create
We just saved 700,000 for a client this morning on that. So there you go.
it can be a very powerful tool
Yeah.
in the right place. So,
Mhm.
and then some of the more complex strategies when there's corporations involved, et cetera, you would look at an estate freeze or use of a trust potentially. So,
And I want to go back because this applies to a lot of you. You guys might be thinking like estate freeze and trust. That's not me, but the tax-free savings account, you can name a successor beneficiary. If you are married or common law, you need to make sure that your TFSA has a successor beneficiary. And what that means is if your spouse passes away or common law partner passes away, and you're both, as an example, maxed out on your TFSA, their TFSA would lump on top of yours and essentially double your room. So when we talk about like tax efficient estates and building up assets, passing it on, it's essentially a way to like take on their TFSA and continue to grow that in a tax-free method. And it also essentially doubles your tax-free savings room. Like if you do sell some of it, you keep that room. So massively beneficial. So if you take anything from this video, take away the successor beneficiary and make sure that that's set up on your account.
yeah, and that comes down to decumulation as well. When you're moving money out in retirement, so you say you've got a large non-registered portfolio and you both haven't contributed to your TFSAs, you might want to contribute to them both equally until they're completely maxed out, so that if one was to pass away, they don't acquire a non-used TFSA. You
Yeah.
want to bump those up so that they're kind of equal, so each spouse has the opportunity there.
Yeah, it's a great point. Yeah. Well, John, thanks so much for joining us on this video. We'll have you on again very soon. And yeah, thanks again for talking about estate planning. And for all of you viewers, make sure, again, successor beneficiary, a big thing, but just make sure your plan actually gears tax savings now while you're alive, but also down the road, you're going to die. Like, your will say who gets the money, but is it actually being passed on in a tax efficient way?